Welcome to The Deep Dive. We're your guide for getting past the headlines and really understanding what's driving businesses today.
That's right.
And today, we are jumping into the Crown Holdings second quarter 2025 conference call.
Yep. Our job here is really to pull out the key numbers, sure, but also the strategy, the outlook. Basically, what you need to know to make sense of it all.
Exactly. We're digging through it so you get the context, the real takeaway.
Cutting through the noise, essentially.
Okay, so Crown Holdings Q2. Let's unpack it. The numbers, right off the bat, they definitely caught my eye. Quite resilient.
Oh, absolutely. So for Q2 2025, earnings per share came in at $1.81. But the adjusted figure, that was $2.15.
Which is a nice jump from last year, right?
Big jump. Last year was $1.45 and $1.81, respectively. And net sales were up to about 3.6% year over year. It's that profitability leap that's really notable here.
Yeah, and that operational side looks pretty healthy as well. Segment income, $476 million this quarter, up from $437 million. That shows good efficiency.
It really does. And look at the first half overall free cash flow, $387 million. It's way up from $178 million same time last year, almost double.
Wow.
And they sent cash back to shareholders too, $269 million return. So yeah, management was pretty happy, calling it record segment income, record adjusted EBITDA, record free cash flow for the first half.
Okay, record results. That's impressive.
Firing on all cylinders, you might say. Turning operations into cash, returning value. Solid.
So here's what I find really interesting. How do they pull this off? You know, in this kind of environment, let's dig into what's actually driving this segment by segment. What are the currents underneath these numbers?
Good question. It looks like a few things came together. You had North American beverage shipments up 1%, not huge, but steady.
Okay.
Then European beverage up strong 7%. And North American food cans, they saw a 5% volume increase.
And pricing, were they able to pass through costs?
Yeah, that seems key. They mentioned passing through higher raw material costs, which obviously helps the top line, but it also suggests they have decent pricing power right now, plus a bit of favorable foreign currency translation helped net sales.
So volume plus pricing plus cost control.
Exactly. Those drove segment income, along with, generally better operations globally.
Which probably explains why they felt confident enough to raise guidance. Let's talk about that outlook. What's baked into the rest of 2025 now?
Right. So given that strong first half, they bumped the full year adjusted EPS guidance. New range is $7.10 to $7.50 per share.
Tighter and higher.
Yep. And for Q3 specifically, they're guiding adjusted EBITDA to $1.95 to $2.05 per share.
Any key assumptions we should know about interest rates, FX?
Yeah, they laid out a few. Net interest expense around $360 million for the year. They're assuming a dollar-euro rate of $1.10, so maybe expecting a bit more help from FX. And a tax rate of about 25%.
On cash flow.
Yeah.
Leverage.
They're projecting full-year adjusted free cash flow around $900 million. That's after $450 million in capital spending. And they expect net leverage to be down around 2.5 times by year-end. So pretty healthy balance sheet picture.
Okay, let's dive into those segments. America's beverage, you said 1% volume growth in North America, but segment income was up 10%.
Yeah.
How does that work? Is it just better margins?
Seems like it. That 1% volume growth in North America, well, it came after 2 years of really strong growth, so some moderation wasn't a huge surprise. Brazil was still growing, up 2%.
Okay.
But management's point was, even if volume growth slows, they expect margin growth because they're using their existing plants more efficiently, higher utilization, better productivity, getting more out of what they have.
Makes sense. Less need for big new investments right away.
Potentially. And they also mentioned minimal impact from tariffs on that business, which is definitely a positive.
And Europe, you said 7% volume growth there, and that sounds like the real standout.
Oh, Europe was, really strong. It was actually 6% volume growth this quarter, but that was on top of 7% growth last year. So compounding gains led to another record income quarter across Northern Europe, Southern Europe, the Gulf. Customers there seem really committed to cans.
The sustainability angle.
Definitely a huge part of it. That shift away from plastic is very real in Europe. They're even modernizing a plant in Greece and thinking about adding another line in Southern Europe just to keep up.
And tariffs not a big issue there either.
Apparently not directly, no.
Okay, so America's steady, Europe's booming, any weak spots.
Yeah.
Can't all be perfect, right?
No, you're right. Asia Pacific saw income drop. Volumes in Southeast Asia were down high single digits.
Why was that?
Seems like tariffs were hitting consumer confidence and spending power in some of those markets. But interestingly, even with weaker volumes, the business still managed an income margin over 19%.
So they managed cost well, even when demand dipped.
Looks like it. The other softer spot was the transit business. That's their steel and plastic strapping. Segment income was kind of flat. Industrial demand is soft, apparently.
Did tariffs hit that too?
They estimated a potential $25 million exposure for transit, but they said that's already factored into the new guidance. So they've accounted for it.
Okay, let's switch gears to North American food. That surged 9%. That's a big number. What's going on there?
Yeah, 9% demand growth. Really strong, mostly driven by vegetable volumes this quarter after pet food was strong in Q1. That plus better result in closures meant the other segment income shot up like 150%.
Incredible. Is that just restocking or something more fundamental?
Management thinks it's partly their own investments paying off, but also potentially a shift. More people eating at home, maybe stretching their budget.
The at-home consumption trend. That could be sticky.
Could be. Makes that food can business look pretty resilient, maybe even counter-cyclical. They also mentioned seeing green shoots in their beverage can equipment business, suggesting global demand for making cans is picking up too.
Okay, so strong performance, good cash flow. What are they doing with the money? Capital allocation priorities.
They were super clear on this. Priority 1, grow the business, serve customers, make sure projects have good returns. Standard stuff.
Right.
But beyond that, with leverage heading below 2.5 times, it's all about shareholder returns. They literally said the number one and only priority after business needs and debt pay down is returning cash to shareholders.
Meaning buybacks.
Sounds like substantial stock buybacks are likely over the next couple of years. Strong signal of confidence.
Got it. Now, there were some interesting comments about inventory. Sounded like they're running leaner than they'd like.
Yeah, that was intriguing. Said inventory levels are no higher than back in January. And they probably have a few hundred million less cans in inventory than we would like right now.
Less than they'd like. So demand is really outstripping their current buffer.
Seems that way. Very lean supply, given how strong demand is. And looking ahead, management thinks 2026 could be a very tight year for supply.
Based on what?
Based on contracts they already have and what their customers are saying about their own growth plans. So they're actually planning to build inventory in Q4 to get ready.
Preparing for continued strong demand then. Where do they see that growth coming from?
Europe and Brazil expected to keep growing. They think Mexico will firm up. And the Americas region. They said it'll be full next year, basically running at capacity.
And Asia in transit. Any rebound expected?
They see potential for good earnings growth there when volumes come back, because they've already taken a lot of cost out. So they're positioned for a rebound.
Okay, so if they're expecting tightness in growth, what about CapEx? Are they spending enough to keep up $450 million this year, you said?
Yep, about $450 million planned for this year. Maybe $250 to $300 million is just maintenance, keeping everything running smoothly.
And the rest is growth.
Right, $150 to $200 million for growth projects, mostly beverage cans, globally Americas and Europe. That includes adding a third line down in Brazil and the big modernization in Greece.
Is that enough, though, if things get really tight?
Well, they did say their free cash flow is strong enough that they could spend maybe another $100 million on growth if they saw the need. But they also put it in perspective, adding one new can line only adds about 1% to their total volume, given how huge they are already. It's incremental.
Right, scale matters.
So it's all pretty fascinating how Crown's performance kind of mirrors these bigger market shifts, doesn't it? Especially that beverage can strength.
Yeah, particularly in Europe with the whole sustainability wave. It really underlines how resilient cans are as packaging.
Totally. And even with inflation having to pass through costs, demand holds up. Seems pretty inelastic, within the beverage world. People still want their canned drinks.
So here's a question then. We see industrial slowdowns in places, tariff issues popping up.
Yeah.
Why does the can business seem to just power through? Is it just recession-proof?
Well, maybe not totally immune, but definitely resilient. Part of it is being tied to consumer staples food, drinks. People buy those even when times are tough.
Right, essentials.
And the other big piece is that environmental angle. Aligning with carbon reduction goals gives them a real edge. Customers want that sustainable option. Management even argued their current margins are only just now getting to where they should be, given the investment and expertise needed.
Interesting perspective. Not just high margins, but appropriate margins for the value provided.
Exactly. And those lean inventory levels we talked about, that just signals strong underlying demand, maybe even gives them more pricing leverage going forward. They seem really well positioned.
Okay, let's pivot. It's time for our This Is Not Financial Advices segment.
Yeah.
Just a fun, maybe slightly out there trade idea based on what we heard. Strictly for discussion, folks.
All right, so thinking about Crown's strong operations, the raised guidance, and especially that tight inventory situation heading into potentially a very strong 2026. Here's a thought.
Okay, let's hear it.
How about going long Crown Holdings, but pairing it with a short position against, say, a major plastic packaging company? Or maybe even a company focused on discretionary consumer durables?
Ooh, a pair trade. Long Crown, short plastic packaging, or consumer durables. That's bold. Explain the thinking there.
Well, it's kind of three-pronged.
Right.
First, you're obviously playing Crown's strengths, the can industry doing well, their execution, the sustainability tailwind, especially in Europe.
Makes sense.
Yeah.
Leverage their advantage.
Second, shorting the plastic packaging peer is a direct bet on that sustainability narrative continuing, maybe even accelerating. You're betting market share keeps shifting towards aluminum and away from plastic, hitting the competitors' volumes or pricing.
A bet on the material shift itself.
Exactly. And third, that comment about eating at home potentially boosting their food can business. That hints at consumers maybe cutting back elsewhere on non-essentials. So shorting a consumer durable company plays on that potential shift in spending away from discretionary items.
So you're capturing Crown's upside, betting against plastic, and hedging against a potential consumer slowdown in discretionary goods.
Pretty much. It ties into their operational strength, their buyback plans, and these broader market trends, sustainability, changing consumption habits. It's a play on the can market's strength versus perceived weaknesses elsewhere. Just a thought experiment, of course.
Of course. Always do your own homework. Okay, let's wrap this deep dive up. Crown Holdings, Q2 2025 sounds like a very solid quarter.
Definitely strong. Raised guidance, impressive operations across the globe. They're executing well.
Key takeaways for you. What should listeners really remember?
I'd say number one, the resilience of that beverage can market is real, particularly with sustainability driving growth in Europe. Number two, their clear focus now on shareholder returns via buybacks, thanks to that strong cash flow and lower leverage.
And the inventory situation.
Yeah, number three, those lean inventories pointing towards a potentially very strong demand and supply picture heading into 2026. That's definitely something to watch. Even with challenges in Asia and transit, they seem to be managing well overall.
Good summary. And just a reminder to everyone listening, everything we've discussed here today is for informational purposes only. It is absolutely not financial advice.
Please, always do your own research. Talk to a qualified financial professional before making any investment decisions.
We hope this look into Crown Holdings call gave you some valuable insights.
Yeah, what stood out to you? The European strength, the buyback focus. Let us know what you think. We're always curious about your take. Until next time on The Deep Dive.